host, Mark Harrison. Our special guest today is Ange Miaouinou from FIS. Welcome to the Callisto Grand Credit Clinic, where we bring together expertise and innovation to thoroughly examine and improve your financial health. In this session, we'll dissect how AI and machine learning will revolutionize your approach to cash flow and risk management. Discover the secrets to mastering your business's financial health, one diagnosis at a time. Let's think of it as triaging the essentials to optimize your credit and collections processes. This session is being recorded for CPD accreditation and will be available in our members section. If you haven't joined as a member yet, please consider subscribing. It is a career boost that is actually cheaper than a Netflix subscription with much more long-term benefits. So remember, this is an interactive session, so join the conversation. Let's make this a dynamic discussion. Share your comments or questions during the session, either via the chat or by putting your hand up and having your say. Today, we're going to look at risk-based collections and the top challenges we face. We're going to look at a brief history of technology and a glimpse of the AI future world. Okay, so on with the show, and a very good morning to you, Ange.
Hi, Mark. Good morning. Good morning to everybody. It's a bit early in the morning, but we all try to make this session lively as much as possible.
Okay.
Ange, you're muted. Apologies.
Aren't you still muted? Okay. All right. So we'll crack on. So let's move on to sort of the first thing we're going to discuss, yeah?
You're back, yes.
Yes, okay, it's fine. I'm back. So just quickly, I was just going to speak about the title. So can you just move back to the title? I'm very sorry. So the title of today is Accelerate Cash Flow and Reducing Risk with AI. I just wanted to, it's a nice title, and I'm sure that's why you joined today, because you want to know more about this. I just wanted to tell today, there's a basic word which is AI, and I understand that everyone speaks about AI all the time. But I just wanted to say that no all solutions actually have AI, and AI is a basic word, but it is not presented everywhere really. And if I can bring you two things today, maybe understand what is AI really, at least in this context, and also how can AI help you in your daily jobs and help you improve your daily jobs. Yeah, so that's it. So it's okay, Mark. You can move on to.
So that's you. Okay.
You are on mute again, Ange.
Okay. Hello. Sorry. Yes, I'm not sure why. So just quickly today, we'll speak about what do you call first. So it's really to understand how AI helps you with prioritizing your tasks. So you have two customers, customer A and customer B. So customer A owes you $50,000 and he has a past due greater than 30 days, and customer B owes you $30,000 and have a past due of less than 10 days. So who do you pick up first? I think, Mark, we can do a bit of, a little poll on the...
So on the chat, please, if you could say whether you would go first for customer A or for customer B. So just as a straw poll, everybody, if you can just say I go for customer A, I go for customer B. Who would you call first? This is your first interactive. So Paulina says A. Anybody else? A's or B's, please. All right. Okay. So far, lots of A's. Okay. Depends on the relationship and the size of the business. All right. All right. Any more? All right. So it seems looking at it, the majority is A. Ange, yeah. So far.
Yes.
Ever?
So yes, thank you for answering. Thank you for participating. So basically, customer A, as you can see, has a risk score of very low, while customer B has a high risk score. So that will define how we will actually score your customers within the platform. And so if you can see, if you can move on to the next part. So the thing is, using the risk scoring model, what we do is that we will calculate what we call beyond acceptable delinquencies. So it's the probability of the client to go bad, so beyond acceptable delinquency rates. So you can see that for customer A is only 2%, while for customer B is actually 50%. Well, so what does that mean? So next point. Yes. So that means that according to the probability of bad, we are able to say that you actually have a cash at risk of 2% over the 50,000 that customer A owes you. So which is only $1,000 that you have at risk with customer A. While with customer B, because it's a high risk customer, you have a 50% probability of bad. So which represents actually 50,000 of cash at risk. So therefore, here in this example is how AI will help you prioritize your task, help you go to the customer to call first to make sure that you get your money or you get your cash.
It's an important thing to bear in mind there, that, as always, and something we talk about quite a lot. Don't just take everything at face value. All right. So obviously, you need to ask questions. Need to be asked below just the headline figure, and hence we ended up that the one you probably call first would be customer B. Yes, or you should call first is B. Yeah.
Yes.
All those of you who said B, well done. Okay.
So here quickly is a bit of an overview. So it's the top challenges that we see that our customers are facing. So we this is not only our customers, but it's actually a large base. So we do that over the last 24 months. And what we see is that 30% of the customer or our clients in general or people working in the order to cash space said that they see a higher and higher volume of invoices while the teams remain the same. So to deal with this higher volume of collections. And the second point or the second challenge that they have is that they see that, especially after COVID, that the number of DSO is increasing, the rate of DSO is increasing, and the past due of account receivables. So how can you deal in this current market with the number of collection volume increasing while you have less staff to deal with it, and also with important metrics such as DSO and AR past due increasing? So I will show you how AI and how a solution can help you do that while not increasing staff and make sure that your DSO level remains low and decrease also the past due in terms of AR. Next slide, please. So in terms of what is risk-based collections, there's, I would say, 4 pillars, so the automated decision modeling. So all those 4 pillars are being used in the first example I used with the questionnaire with customer A and customer B. So really automated decision modeling, statistical probability, leverage your data, and maximize your productivity. So about automated decision modeling is really using AI intelligence to continuously and consistently measure the risk of customer become delinquent. So really AI will really help you that. And then to complete that, there's also everything about the statistical probability of your existing customer using a risk-based model to predict really the probability that this customer will become delinquent or the debt will go bad. So all this really prevents you even before the customers actually go bad to really take the right measure and put the right measure in place. But what's really important as well is your data. I've learned a new sentence which I think it's great, is that it's true that cash is still king, but data is King Kong, in the sense that it's really important that we leverage the data internally that you have and combine with the behavioral payments and so on to be able to build an accurate risk models around your customer and your database. And all that will really help you gain in productivity. So maximize your productivity in terms of really have an understanding of the category of client that you have and the classification of where they are in order to prioritize really how you chase your clients. So all this really is to help you do what? Chase the right client at the right time with the right amount of effort. So really, that's what we want to get at. Thank you. Next slide, please.
Okay.
So here it's a great example of how artificial intelligence works, because artificial intelligence really what it does, it will be able to spot patterns that will be kind of hard for you to spot. So given the first numerical suite, can you tell me if you see any pattern there? If anyone, please on the chat, feel free to tell me if you see any patterns. I guess it's hard to see the pattern. Maybe if I give you more numbers. Yes, maybe the second line entirely. That's Mateus, that's a good try, but this is not it.
Not wrong though, they are going up.
So can you give me more numbers? And if I give you all that, I give you a few seconds to tell me if you see any patterns. I promise you there is a pattern.
It's
So
plus
really,
1 plus 2
+1 +2 and
plus 1.
no,
Plus 1 plus 2 plus 1? No?
no. No, but it's a good try. It's a good try. It's a good try, but it's not. I mean, you're not far. You're not far, to be honest. You're not far, to be honest.
+1 +2 +3 and so on. So
+1 +3 and
sorry, no, it's +1 +2 +3, but then it's not working. So
exactly. So, but you're not far off. You're not far off. It's a good one. So basically, it's +1 +2. Then you multiply by 3 the next odd number. And that's all the way. And then you come back. So +1 +2 and by 3 the next odd number. So anyway, so just to tell you that artificial intelligence really what it sees, it will help you recognize patterns and help you make decisions on things that will be hard for the human brain to see, or patterns for the human brain to see. So that's fine. Next slide, please.
And this is an example how AI or machine learning is seeing trends and patterns, that takes us a long time to see as humans, but the systems can pick up these kind of formulae and so on. It's the same like with cash allocation. If you're looking for like certain patterns within account number trends or something like that, that's what this example is leading to. Yeah.
Yes.
Okay. And that's the rest. You want to move on to the next slide? Yeah.
Yes, please.
Okay. So some history.
Okay, yes, here is some history. So basically, it starts in 1950, but obviously people were chasing invoices even before that. But just to make you understand how, in terms of the evolution of the technology in receivable works, is that really before in 1950 it was very manual and and very much like paper based and with large amounts. And with kind of cyclical results, but really not introducing any automation to it. Then we'll say a bit later on, I would say like maybe 35 years ago is actually when our solution, which was the first solution order to cash created, was launched. Then you implemented a bit more strategy, automations, and you're gaining in time. You're gaining in time with some cash flow improvements, a more kind of reactive approach, and and have a better result over time. But now, nowadays, we, as I kind of try to explain throughout this presentation, we are introducing more and more artificial intelligence. And what does it mean is that really it's over time, really have a continuity in terms of improving your cash flow, have a proactive approach. As I said, and I was giving the example earlier, what you want to do is get to the clients before it's actually go delinquent. So that's what AI will help you do. So prevent that the probability of bad or the bad, so the beyond adequate delinquency rates. So that's what we want you to do, be proactive with the client and make sure that they pay you in time while identifying the right person to contact. So that's where we're getting at the moment. So yes, thank you. So here is a bit of a case study that we have for a global organization that we were working. So as you can see, this organization was a bit complex since they were using 7 different ERPs. They have they had an open AR of like around 500 million, and the past due was 90 million overdue ARs. So, and then when they implemented the solution, 3 months later, we actually saw amazing improvements. And in terms of improvements, we can see that, for instance, the open AR has increased a lot. Mark? Yes, so the open AR has increased a lot, about 75 million, which is about 50% increase. So what does it mean? It means because of the automations we have been able to implement, they were able to increase the volume of AR they were able to deal with. So really, that's a question I get often asked: is AI here to replace credit manager or collectors? No, it's really to add an added value and to enable you to do more with less, basically. And also, as you can see, and that's a very important point, because it's everything which is what the return on investment when you're investing in such tools or technology, is that you see that your overdue AR decreased from 90 million to 67, which is about 23 million. But in terms of interest, if we take interest rate about 5 to 6% nowadays, is around 1.2, 1.4 million of cash, additional cash that you're gaining. And as I'm saying, is really to help you your team do more. So it represents actually 15% of less resource required. But no, because it to replace people that doing the job. It just help you to do more added value tasks and other tasks to help your company. So
Before we go on to the next slide, then, 'cause this is obviously the sort of the nitty gritty of what we're talking about today. And we're focusing here on, like, let's say there are 7 legacy ERP systems. That can be Oracle and SAP and various instances of that. Is this an argument then, really, that having a third-party provider, yourselves, you don't have to kind of integrate ERP systems, that you can be much more dynamic if you actually work in the cloud? Right? And this is something I actually believe as well, because so many companies now, for example, are going through the S/4HANA transition, right? And I'm kind of open to be convinced, and I think many people are, I mean, yes, that can go on anyway, because that has to happen, but that doesn't have to be the be all and end all. And to keep as you're showing here in this model, to have the improvements in the receivables, working with a solution such as FIS, means that you can be basically working outside of the ERPs. Everything is rooted in, right, into the cloud and to your solutions, and that makes it much more flexible and dynamic, rather than trundling along with the ERP and as it says here, like 7, or it could be more, couldn't it? Many legacy systems. It's not unusual, yeah. So is that's kind of one of the main benefits of working with yourselves in this case, yeah?
Okay, so thank you, Mark, for this question. Very interesting question. So I will try to answer it in sections. So first of all, as you mentioned, like some companies has 7 different ERPs. What does it mean when they have, like, they take a solution such as an FI solution? It means that they have one cohesive platform where all the information is regrouped in, so they can have a global view. So what does it mean? It means like more visibility, more automations, and more communication within the teams. And that's something that we really promote to our customers, and they see the benefit out of this. And also the very important thing is that, as you mentioned, rightly mentioned, an ERP is an ERP. Yeah, it's not an order to cash solutions. It's not meant to automate or to gain so much improvements in terms of cash flow, collection, prioritization, strategies. So there's not all those elements really will improve how you chase your customers, how you strategize everything's around your order to cash. So I think I hope that answered your question, but really that's the idea when you're taking solutions such as
I kind of agree with you. I don't really understand why many companies spend a lot of time and money, sort of doing the Oracle SAP integration or whatever it is, where I think there are, it's kind of crying out for much quicker solutions. That's open to the audience as well, to everybody else. What are your experiences? Are you kind of staying with your SAP, your Oracles and so on, or are you looking at? Are you also looking at third parties to overcome this multiple legacy system issue, which I think applies to pretty well everybody? Yeah. So, okay, so we'll go on to the next slide. Yeah.
Yes.
Okay.
Okay. Here, sorry, you missed a slide. Yes.
My apologies. Right.
No problem. So here is really speaking about how AI impacts your entire order to cash processes end to end. So basically here is just to help you understand that AI can intervene at every level of your order to cash process. So it can intervene at the credit risk level, because as I rightly mentioned, we do have AI that will help you do a risk model of your entire portfolio. So really how you have like a customer behavioral payments and how we adapt risk with AI throughout that. How to automatize, so how to send automatic answers to your client according to the risk level. And for instance, also in terms of cash application, which is also very important, how to read and recognize an email and match it with the payments. And also in terms of how to accelerate disputes, identifying the right route or the best routes in terms of how it was resolved before. That's a bit more machine learning than AI, but how it was resolved before, if that route works a lot better now, how to prioritize that route in order really to increase the cash flow and how you resolve problem quicker. So just here really to make you understand that AI will intervene on a different manner, and depending if you're talking about credit risk, if you're talking about collections, dispute, or cash applications, but AI is really present on the entirety of your order to cash processes.
Right. And there's so just before we go on, then obviously the main topic that we're talking about here is around the credit risk and so on, because you were saying at the beginning about that. So how does that in practice with FIS then, how does it actually interface? So are you working with external agencies, or is it your own modeling? Is it customers modeling, or is it a combination of?
Okay, it's thank you for the question. Very great question once again. So how it works is that you have a bit of everything. So just to make sure that we get the full picture. So as I was saying, there's internally, so the AI will have an understanding of your internal behavioral payment of your customers, then build a risk model around that to make sure that we understand how your customer pays you. And I always say that's, for me at least, the most important, because you can be AAA on the market, but if you're old company, you're not gonna pay your suppliers how you pay your marketing agency, because there is difference in terms of priority. And also a good example of that is the big Tesco's and the big supermarkets, where they're notoriously known not to pay the suppliers on time to keep more cash. So there's a difference with that. And then also we do work a lot, for instance, with DNB, which is one of our partners, and actually DNB also use our solution. So what we do is that, in terms of having a full picture of the risk model of your portfolio, what we do, we only have internal review, but we have external. So we integrate DNB and other credit bureau information within the risk model in order to give you a kind of adjusted or weighted risk model of your client. And that's very flexible and adaptable. And one of kind of the great added value of our solution is that according to your experience and your understanding of the market, you can put a different weight to those different categories of way to risk assess your customers.
So it's a combination of everything. So customers' data and external information as well, coming from, like you said, DNB and Moody's and so on. Yeah. So,
exactly.
Okay. And that's where the AI or the rapid technology comes in, bringing all this information together, right?
Yes.
Is it also flagging up? So I was just thinking of other, in terms of the risk side, when there is adverse information, right? Slowdown in payments, or the credit bureau has a a reducing credit limit or something like that. How does that actually visualize itself for the collectors or the risk management team within a company?
Well, it will be flagged, and if, for instance, if there's something within the application which is ordered and released, so basically, if the risk rate of a certain company decrease on the market, or if, for instance, the behavioral payment changes, it will impact its credit risk, and it will impact if it's low risk customers to maybe medium or high risk, and that will be flagged to you. So this is where I'm saying it helps you, because you do not really have to, obviously you need to pay attention, but it will help you kind of know directly, and before it's the client actually go bad or delinquent, that be careful, this client behavior or this client rating has changed. You need to pay more attention, or you need to change strategy in terms of how you chase that client.
And is the information coming in from external sources, Moody's, DNB, etc., is that also including things beyond financials as well? Because a lot of the risk these days is based on many other things that are not just financial data, right? So it could also be things like a change of ownership, change of senior executives, ESG compliances or not, climate risk, political risk if a companies are in a volatile region. So I guess you can kind of choose the information that you want to go forward. Yeah. And like Brad's saying here, listening to news feeds, is that part of the model as well?
I think that's the next step. I don't think we do integrate those because non-quantitative data that you mentioned, that I already mentioned. No, because at the end of the day, it would be very hard to kind of quantify it really. Although we do have, even because FIS have 500 solutions, and we do have solutions that are looking at everything which is ESG and climate risk and so on, especially for insurance companies, we do provide that. However, as of today, that's not, those non-quantitative or hardly quantitative data are not integrated within the risk scoring. To be honest, but that's a good point, because I think that's the next step, and that's where the trend of the market will tend to go to.
It's interesting that, because we've done a couple of other sessions in the past where sort of non-financials is becoming as much of the risk modeling as the financials as well, indeed the regressive data from cash collection trends and that kind of thing too. So okay, you finished with this slide? We'll go on the next one.
Sure. Okay. Sure, and here is a bit again working, tell you how AI will impact your collections. Here's more kind of a great example how he follows through. So really what AI will do is, through multiple type of data points and to determine the propensity for your client to pay, they will identify them. So there's all the process to identify who are your low risk customers, who are your high risk customers. And then according to that, what we're going to be able to do is do prioritization. So it means that how you're going to chase your clients. So as to go back to the first slide we made, so who to go first to? So do I go to a customer A first, or do I go to a customer B first? So it will help you really doing that.
Sorry, carry on.
Okay.
Before we go on, there's a good question here for you as well on the chat. Yeah.
What is the pattern of assessment in the case of financials? Missing. Okay, so and that's Alexander. So in terms of so the question is, if actually they don't have the financials of the company, how does the risk model work? So as I was explaining, the risk model works in different types of ways, and one of the ways that it works is the behavioral payments. So basically, we will take what is about 18 months of data, because we need to have kind of as I said, data is king kong, so we need to have like a good certain amount of data to be able to understand what the behavior payment of these clients. And so according to that, we will be able to give a risk scoring to these clients because we know how he pays, how he pays. And for instance, I think that's a very interesting kind of example that I can tell you is that let's say the invoice is due on the 31st of the month. But this client, because maybe internally the time that all go to the process, or usually pay on the 2nd of the month. So on the 31st of the month, the tool will not tell you go and chase this client because we know from the 89 past month that this client is paying on the 2nd of the next month, and he will let you, he will help you prioritize that. So and prioritize all other clients that haven't paid but have the propensity not to pay. So it's more in that term. And then and also what I was saying in terms of coverage, so you have like a really coverage of your entire portfolio. But really what you want to do, what you want to get at is, and I think that's also will be on my next slide, is that really to have an automations of 80% of your entire entire portfolio of customers. And why I'm saying 80% of your entire portfolio of clients is because what we tend to see on all our clients, if you can see the white line, is that really your high risk customers and your extremely high risk customers will usually represent 20% of your customers. Otherwise, if you represent more, that maybe your business is not that good. But it's just that what we want to do is that really help you automatize all which is low risk and medium risk customers, because that are customers that will be paying you, to help you really understand and have a focus on your high risk customers where you need maybe more calling them or more manual interventions. So the 80% will be really automatized, so you can really focus on the customer that don't pay and make sure that they pay on time. So yes, so yeah, that's fine.
I think staying with Alexandra's point here, I think it really kind of emphasizes the why what you're describing, Ange, is so important, right? Because whether there's a DNB or Moody's or others are available, even if you have financials, they're often, like in the case of the UK, for example, you don't have to submit files of your limited company for 10 months, right? So they're almost a year out of date before they're actually sent to company's house and so on. So the real business intelligence is what happens on a day-to-day basis, right? So it's, as we've been saying, and it's not only cash, it can be other trends, an increase in disputes, more copy invoice requests. There's all sorts of various indicators, aren't there, which have always been the way. I mean, this is nothing new. This is how it's been since I started in the 1980s and so on. But what the technology brings is bringing all this information rapidly to the collectors, the risk teams, and so on. So it's we can also kind of look at companies that are not limited, so lots of smaller companies. So it certainly doesn't prevent initiating a relationship, as you said there, because I think in some ways it could actually enhance it, because if you've got this data coming through quickly and you can see the trends, like if they are paying on time or something like that, that's a good sign, so it can also be a positive as much as a negative, this information as well. So, okay. Back to you, sir. Ange.
So I'm fine. If you maybe next slide. So yes, so no, really, that's kind of my final slide, and I hope you have the bit more interesting was AI and how can AI help you really on your day-to-day basis. But really, if I want to kind of really finalize everything we said, is that really what a solution such as an FI solution, which is called Get Paid, I never mentioned it during the presentation, but anyways, is that it really helps you to have automation, as I was saying, throughout your entire order to cash processes, to improve your DSO, which is usually the most important key metrics, but there's all other key metrics that you want to look at. And really reduce also your AR, your account receivables overdues. So those two are the derivatives, and this is how we can say, okay, I'm buying for these solutions, but the return on investment is so important. And as I mentioned in an example, only on overdues, not even on increasing of cash flow, etc. You're kind of saving 1.3 million in interest rate that you might be paying to a bank. So all those things make it really for me a no-brainer to go and say, okay, I need a solutions to improve my order to cash processes, and I want to move faster. I want to get paid on time. I want to increase my cash flow, and that brings so much benefit to the company. And also on a day-to-day basis, it's so much better for the people working in those departments, and they help them, maybe do more strategy or do other stuff that have more added value to the company. That for me, it's a no-brainer. So as I said, at the end of the day, really, if you want to improve and increase your working capital and cash flow, you should consider a tool such as Get Paid for the type of results. Yes.
I think, another good question here from Alexandra. I think this is one for everybody, actually. I think it would be an interesting thing to share. How often does everybody review their current portfolios or the credit limits and so on? So I think I'd like, if as many people as possible, if you could just jump in there. Is it every week, every month, every day, every year? I'd like to see kind of what's the trend there. But I think perhaps one of the answers to that question really is with the technologies that are available now. It's not something that has to be done. I mean, you should still put in your systems that you check the credit limits every year or something. Maybe there's a minimum once every year. But with the technology now, the system's actually doing it for you. So what we used to do kind of historically was make this sort of a scheduled event in the diaries, quarterly, half yearly, annually, however it was. Now the systems are doing it for you and they're telling you, right? So it's a bit of it's kind of, things are kind of changing now, However, the adverse information, if it is adverse information that's is put forward, as Brad says, you still need people to interpret that information and do something with it, right? And that's still something we must never forget, right? The systems will tell you they're slowing down payments, this has happened, that's happened, whatever, but you still need people to actually respond and do something to that, right? Which is where we need to have skilled people working in credit order to cash to be actually to able to interpret this information and be effective. And this is what I think this is what you're describing, Ange, as the value added jobs, right? So it's moving a million miles away from processing into actually being what we used to call in the old days credit controllers. We are controlling the credit with the information we have at our fingertips, which makes it so much easier if we call ourselves credit controllers, right? It's then we're very clear what it is that we're doing, right? Okay, questions, please. Lots of stuff coming through now. So Dalma says their credit limits are checked monthly. Flavian says quarterly. So you see, it varies from company to company and industry to industry, doesn't it? But the thing is, it needs to be done on a regular basis, right? It must be absolutely part of the housekeeping, right? Okay. So we're down to the bit that says Q&A, right? So, but some very interesting stuff you put forward so far. I got some questions to kick off. All right, so if I may, Ange. So let's see what we got then. I think we're talking a lot about AI. All right, so artificial intelligence. Are we really talking about AI, or are we? Is it machine learning, or is it a blend of both? Right? Because I think there are the kind of all these phrases being bandied around at the moment, aren't there? And I think we need to be clear whether it's AI or it's machine learning, or like I said, a bit of both, right?
Yeah, it's a bit of both. I think for AI, an example that I can take, or machine learning, one I can take, which is maybe clear example, is that, for instance, when you have cash application, for instance, we're using, so cash application basically is how you matching open invoices with payments. So, and sometimes your invoice is incomplete, is missing a number, or the template is different, or they have changed the template, etc., etc. So machine learning in that case, for instance, so the solution will tell you, oh, I was not able to completely match this payment with this invoice, but I can see a certain pattern, so I believe it might be this. And then you will have to look at it manually, and you said, indeed, it is this invoice, and you will tell you will register for this particular example that you need to look at the invoice number and the amount, and that's it, and you will integrate that within the solution. So what the solution will do, it will learn that the payments went to this bank and was paid, and recognizing those different patterns, and will learn this pattern. And then the next time around, you will not have to have an intervention, like manual intervention. So which means that he has learned from what you have done. So that's what we call more machine learning. So that's an example. And then in terms of AI will be able to read the email, see the different information within the email, and directly do the matching, and that will be more AI. I think that example for me speaks to me, but I don't know if it speaks to the audience, but it's the best example I can think of.
And it's a great point you make, actually, because you're saying that it needs human intervention to kind of teach the machine, so the machine is learning, and the second time it'll do it. And I think this is a very important point to stress, because I know there's quite a lot of players in this space now, and I think some people have been, I don't know, they haven't actually received what they thought they were buying, right? So that's also this term of AI. I think whenever anybody is doing the RFIs and all that's out there, your request for information, really ask that question. What do we mean by artificial intelligence? How much is actually done with us? We can put our feet up on the desk and have a cigarette or whatever, and the machines will take over. I think we're still quite a long way from that at the moment. We can't just say to Siri, match all my cash for me, right? We're not there yet, right? So I think it's and there's nothing wrong with that. It is a blend, it is a combination at the moment. And I just, from our experience, I would very much say when you're looking to work with Ange and others, ask that question, right? Because it's important. Because I think it's fair, because we're kind of talking about the trends and the things that you see at the moment, Ange. That's the next thing I'm going to ask you. I think it's also fair to say that the technology is where we are today in 2024. It fixes a lot of things very quickly, but it does mean that we still need people who are actually working in other areas, right? So it doesn't. So if anybody has any fear about losing jobs, it's very, very, very unlikely, right? Yes, it'll take away from cash allocation, because that's essentially a process, and being able to kind of read characters and match them and so on. Absolutely, right? That's what technology should be doing. But the next phase up, the next thing is, like, with all the other opportunities that it provides, and that's why we need to get data savvy, as you said right at the beginning, Ange. Data is, how did you describe it? So cash is king, data is
King Kong.
King Kong, that's it. Yeah, thank you. Which is absolutely spot on. But it's, and that's why we as Callisto, we stress that everybody working in our area, there is a lot of learning to be done, right? And you need to be, really upskilling and training, not learning processes, learning about end-to-end business, which is kind of where we come in. But and just moving on from that and coming back to your last point, Alexandra, it's a great. It also brings up something that we talk a lot about in Callisto, and I'm sure from the point of view of FIS as well. What you're describing there about being reactive, when a credit limit's exceeded, you can use technology to create very simple predictive analytics, right? And you don't need to be a rocket scientist or a data scientist or anything. You can make some very effective and very simple predictive analytics, which we'd be very happy to tell you about if you want to give me a call afterwards. But moving on. Moving on to other questions. You were talking about kind of the whole O2C cycle, Ange, earlier, collections and risk and cash allocation and disputes and so on. With all the different modules that you provide, is there anyone in particular that's getting the most attention right now? People are coming to you saying we need to have X solution, and why? Or why is in
I mean, first of all, the way we kind of package our solutions is that you have, credit collections and disputes on one user have access to the tree because they are interconnected, and for us it's very important, and that's why we provide a really like live interaction within those three part of what we call our core solution. But now, in terms of like what people are talking to me right now and why they're coming to see me, I have to say it's credit and risk, because I think the trend in the market is that, as I was saying, is that people are not getting paid on time, and people want to have more and more the sense of risk that they're taking when they're onboarding a client, and as you were talking about earlier as well, is that you really want to have a sense of risk and how to prioritize who you're talking to, and at the right time, at the right moment, to make sure that your client is paying you on time. So I can see in my RFI, RFPs that risk level. So in terms of how you set the automatically create limits, how you review them. We spoke about a lot about what's the right period. Is that, and I think you rightly pointed out, is that thanks to AI and thanks to the technology that we have today, is that it's been done on a daily basis. You can do it on a daily basis, and also some companies, because we're working a lot with large enterprise, they even have credit applications where you have your financials and all type of different data that you can integrate, and that can be reviewed every 2 months, every 2 months, every month if you want to. It depends of your what you think is relevant. So. Yes, so you're basically yes.
I was going to ask what was if there was like a kind of a fixed moment in time, what was the catalyst for inquiring more about risk? Was it kind of coming out of COVID? Was it the Ukraine situation? Is it ESG? Is there because I know we know ourselves from our experience, a lot of companies have been, or frankly, scandalous at the way they measure their credit risk. And many companies don't do credit checking at all. They're big corporates I'm talking about. Is ESG, and the very fact that this is something that's actually page one of an effective business, is kind of compliance and that kind of thing also driving the towards you guys as well?
If I gotta be honest, ESG is very important, and I did have the opportunity, but not in that job and other jobs, to look at ESG. However, now I cannot say that it is impacted at least the pure order to cash space at the moment. So companies do look at it, and I think that's been in place, for instance, in England, in terms of for bank lending. So if you're ESG compliant in terms of weighting, I mean how they weight and cost of capital, and how your risk base is effective, you're not ESG compliant. However, because as of like just like the order to cash space, ESG is not, I don't think is a factor that's really been integrated as for now.
Okay, so really, the main driver then is the interest rates going up. That's one of the key.
Yes.
Yeah, so all of a sudden, as is ever thus, it's getting expensive to borrow money short term again, right? So the need to get paid on time is driving it, right? So good, and that's really how it should be, and I think hopefully one of the lessons learned from this current recession is that there will be another one. Right, and if anybody Googles when is the next recession, they will tell you now it's going to be something around 2032, right? So if you're, so it's not a surprise, right? And excellent economists like Vladimir Vanyo, who's with us here as well, he'll tell you that they come around rapidly, right? And most of us have seen them ourselves, right? So yeah, thank you, Vladimir. Absolutely, yeah. But every 10, 12 years, we have a recession, right? Something like that, yeah. So the next one is not going to be a surprise, right? So okay. Let's move on to the other questions then. Something else that gets put around a lot, Ange, and you see it on LinkedIn, and a lot of these people, I think, kind of perhaps should know better. They ask the question, kind of things like, why do projects fail? Why are projects not reaching their full potential, right? From your experience, 'cause obviously you're working in, you have many projects ongoing with FIS, and perhaps what you've done in the past. What do you recommend when you're when you get a customer and before they start, what do you recommend for it to be successful?
Okay, so one thing I recommend, and first of all, I think it's for project to be successful, is that those projects has to be visible. I will say from top to bottom, and CFOs have to understand, for instance, that in my case, to understand the importance of such project. That's one thing. So like really that all the management and every party involved not only understand the benefits and the array of such products, but also are involved or help the right people to be involved. So that would be my second part is sometimes for that type of projects, you tend to not put on the right people. What I mean by that is that you estimate that that's your best people and you want them to be present on your work on your daily work and daily problems. However, those people that are the best at their job understand how best is to strategize and to put on place the project. And sometimes those people are not put on projects, and you need to do that. That's very important because and also that's something I always say, implementation is the most important part of implementing your solution, because that's why we'll drive the entire life of the solutions and making sure that the solution is used well and is used efficiently by the right people. But that's also, it's very important. So to make sure on the company side to put on the right resources, because sometimes they say, okay, we're paying for the project, but when the project starts, they're not committed to help our teams, because there's things that our teams can do by themselves, but there's also things that they need. And so either the IT team or either the collection team to be involved in the process and making sure that everything is put in place and they understand the implications of every part of the implementation process. And I think that's where like we see lack of kind of commitment, not only for management, but also for the best members within each department to be involved and make sure that the implementation goes well.
I think right at the very beginning, you said it has to have buy-in from the top, and not only buy-in from the top, that news has to be cascaded right the way through the organization that we're doing this, and this is why we're doing this. So there's going to be new reporting and new visibilities and a whole new way of working, really, because we're doing this to get paid, basically, at the end of the day. Yeah. So all the sales guys that are been a bit laissez-faire about getting paid and so on, there's a new sheriff in town, basically, right? And everything has to change, right? And I think that's absolutely right. And that point has to be driven and driven and driven, doesn't it? Until it becomes part of the culture, right? And then the other thing that you said, which obviously is dear to our hearts in Callisto, is you were saying having the right people on the project. Who are the right people for the project, in your opinion?
Well, the right people for the project. I mean, it depends. First of all, I don't think there's one way to answer that, because it depends of how your organization is kind of structured. But definitely, I would say on your side, you need to have a project manager that will oversee the whole projects and making sure that everything is done is done according to plan. There's the IT departments, because they need to be implementing, because I mean the solution that we are selling is integrated directly with SAP. So either you need someone for your SAP team, for someone from your IT team to make sure that the integration is made properly. And also I always advise that someone from operation be included, either as maybe someone at the manager level, because in the solution you have like a managerial way of looking at the access or looking at the solution, but also someone from pure operations, either in credits or dispute or credit, and once again depend on the structure of the organization. But really make sure that at kind of each level, from IT to operational, that people are involved within the implementation of the project, to make sure that the right message is conveyed internally. We like to use this word as like kind of who is the champion within the company to make the deal progress, kind of, but who are the champion in different departments to kind of communicate what's happening in the project, when the project is going to be delivered, and what are the benefits of such projects.
I'm with you on that, and I think that we would absolutely advocate, and Alexius said it here as well, that the operational people must be front and center of these projects. We do a lot of workshops and a lot of sessions around Europe, and this conversation always comes up. And so many companies say that the technology that they're given, the software that they're given, doesn't do what it's supposed to do because it was implemented by IT people or the business people who don't have a full understanding of what the operational benefits of it are, right? So, and I think there's so many opportunities here too with these projects that to engage all the credit order to cash people, right? And there's so many things you can look at, and the devil is in the detail. Was data is King Kong. King Kong can be very friendly, or he can bite you badly as well if you don't treat it right. Yeah. So you got to really understand and respect your information. And this is nothing new. Again, this is facts from 100 years ago. You look at things like how many payment methods, how many payment terms, all sorts of other information. How many invoices do we raise? How many credit notes do we raise? There is so much information that needs to be looked at because this is the opportunity for standardization as well. I've worked in a company that has something like 200 or 300 payment terms, right? And they're all just variations. There's only 20 you can actually have at the end of the day, probably 20, something like that. Yeah, each business unit had variations on, net 30 plus 5, net 30 plus 6, net 45 plus 3, and minus your mother-in-law's age or something. They had all these weird and wonderful combinations. And the whole point of shared services and the whole point of technology is to standardize these things. This is lean projects as well and stuff like that, right? So there's so many wonderful opportunities here to really do what shared services is supposed to do, and to give the technology the full chance to do what it can do, right? So, but it goes right back to the beginning. You got to really understand your data, where it comes from, its significance, what you can do with it in the future, which is a lot different to maybe what you've been doing now. I've seen many occasions also firsthand where companies have just gone back to what they've done before. All that's changed is it's got a new shiny dashboard, but they've actually just bespoked everything back to the good old days. Missed a million opportunities. Have you seen that, Orange, as well, where they just kind of just put everything back to what it was before and not really taken advantage?
Well, no, in terms of our solutions, what I've seen actually for a very big company, and now they kind of, I believe they upgraded it. So they implemented our solution, it was doing very well, but they felt like they wanted to build something on their own for some reason. So they spent millions of euros trying to replicate what we were already doing. That is, our core, strength and what we do for every year, and we have so many customers. And they picked millions of years, and now from the last news I'm hearing is they're trying to now go back to our solution because all the efforts and millions they're putting on trying to build a solution still doesn't bring as much benefits as we do. So so yes, but as of implementing our solutions and go back to the old days of manual working, I don't think no. I think when you go to an OTC solution, not necessarily ours, but when you go to that level of automations, that level of strategizing all your entire order to cash flow, I don't think you can go back to old method of manual work. That I don't believe. And it's like the old Nokia 3210. You have an iPhone now. I don't think anyone can go back to that. So I would say I think that's the right analogy. I don't think there's a way of going back to that.
I'll go with that. And I suppose I'm one of those. An iPhone is that's too much for me. but really embrace every opportunity that there is, and it's a great opportunity for people to really open their minds and say, can we do this? Can it do that? Can we make, can we really push this technology as far as we possibly can, right? So, and that's the exciting thing about it, isn't it, really? As we say, credit has no limits. And I think very much in what we've been talking about today, you can keep pushing the boundaries of what's possible through. It doesn't have to be that complicated, is it? You want different kinds of reports to go to different people at different times. That's the beauty of what we've been talking about this morning. Yeah.
Absolutely.
Okay, so we're nearly at the end. So just going to kind of wrap up now, but thank you, Ange, thank you very much indeed. As always, if anybody has any further questions, please keep firing them through. We will get back to them. So we're nearly at the end of today's session, and thank you all for your energy and your enthusiasm. Remember, the session is being recorded for CPD accreditation, and it's available in our member section, like we said. Just a quick word from ourselves. We bring these kind of sessions to you free of charge, but there are costs attached to doing this. As you know, we do this from a green screen TV studio. There's the cost of the organizing, the technicians, everything that you're seeing in front of you here. And remember, a subscription is cheaper than Netflix, right? Ange and FIS will be with us at the Credit Matters conference, along with more than 200 other credit professionals, and you're all very welcome to come and join us there. And follow us on LinkedIn as well. Stay updated with the latest news of events and other things that are going on. We're back again on June the 5th with the Coffee Club. So, and remember, before we go, thank you, Ange. It was a lovely session. Thank you so much indeed. Thank you everybody from attending from all over the world. I know we've got people from all over Europe. We've got people from India and many other places as well. So bless you all. Thank you all for coming. On that note, take care, stay safe, God bless. And as we always say, carpe diem. See you soon. Thank you very much indeed. Bye-bye.
Bye.
Bye.
Bye-bye.
Bye.